You're listening to the Reinvest Podcast, where each Tuesday we will show you how to reclaim, reconnect, and refocus your life by bringing you the top real estate professionals in the industry. We'll pull back the curtain so you can implement these tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. All right. Thank you for joining us on another episode of the Reinvest Podcast, where Seth and I get to show you how to maximize your life through the power of real estate investing. I read this quote, you can't manage what you don't measure. What are your thoughts on that?
That's very deep, but it's true. If you can't, if you don't have the goal in mind, you're never gonna reach it. You're never gonna get there. And so, yeah.
Well, I think it's important as you're listening, as you're building out your strategy. It's so easy to get into the hustle of what you're doing every day, grinding, and you kind of are wandering aimlessly. There's another quote that says, "Hey, you can climb the ladder, but if you get to the top and you climbed the wrong ladder, you know what benefit did that have?" Kind of Stephen Covey type stuff. So we're in the process of measuring things both individually. I've got an intention journal that I'm working through right now, and then also in our business so that we can figure out what's working, what's not, what pivots do we need to make. Otherwise, you'll just spin your wheels. So, but today, this is an exciting one. Short-term rentals have been in the limelight with the advent of Airbnb in recent years. If you're a millennial or younger, you've probably been at an Airbnb. Hopefully anybody older has heard of Airbnb at this point. If you haven't, you need to get out from underneath the rock that you're in. And today, to kind of demystify this strategy, is techie and real estate investor Sief Khafagi. Sief, how are you, man?
I'm good, guys. Thanks so much for having me.
And did we pronounce your last name right? Is that?
You did.
Okay.
You did.
Bonus points
sure.
for that. What? I mean, when people butcher your name, how are they mispronouncing it?
I usually just go by Steve at Starbucks. So if it ever goes wrong, I'm just call me Steve.
Steve.
But you know, and like the natural tongue of saying it, the only person that gets that right usually is my mom, and that's usually when I'm in trouble.
Oh, nice.
So you got it right on.
There
Sweet.
we go.
Well, you're not in trouble, but
So, Sief is an executive turned real estate investor, or ex-techie turned real estate investor. And so where were you working before you jumped in to be a co-founder of TechVestor?
I spent 5 years at Facebook, specifically building teams and infrastructures during, or Meta, as they're known, for one of their highest growth periods, building their second largest engineering team. So if you ever had Instagram or Facebook go down and everyone freaks out, that was my team.
wow.
And anytime it would ever go down, you know, the people that were hiring, the engineers, the product managers, the infrastructure, site reliability, that entire org would scramble because, you know, minutes lost is quite literally millions, if not hundreds of millions of dollars, let alone really angry people. Really, really upset.
Dude,
so
I want to give your entire team a virtual hug because it's funny how entitled we are now with technology, where we just expect things to work all the time. And people don't even know that your division exists until there's a problem. And that's just kind of it's kind of like when you're doing like PowerPoint at church and you fumble the slides and they're like, oh my gosh, you're like totally throwing the ambiance off of things. So putting out fires professionally, that's a tough gig, man. You had to probably grow a thick skin to do that.
You know, I think the entire org had a thick skin. So, well, I'd love to take a lot of credit for it. It was certainly the engineers that were, you know, working their asses off to make sure that went down.
Yeah.
I just had the privilege of bringing them into the role and telling them how great it would be, which, you know, I think they would agree with me that Facebook's a great place to work, a great place to grow your career, build a family, and really scale a lot of things and work on a lot of challenging problems. I think I gave a very generic understanding of what they did, but a lot of the tough problems that they solve are, in fact, pretty incredible.
I was one of the chief architects of MySpace. So
okay,
I just want to put that out there. But
no, he was not. Disclaimer: no one sue us. So now you are with TechVestor, which you were the one of the founders of TechVestor. And so why don't you bring us up to speed? What is TechVestor, How much have you grown? When did you start? Just kind of give us the short version real quick.
Yeah, so we started working on TechVestor in mid to late 2021, and announced it then. We hit product market fit probably within, I don't know, October roughly, when we first raised our first $7 million from investors. So in short, TechVestor helps you invest in short-term rentals passively, where you don't have to do any of the work. So it's a syndication model, and you can invest with as little as 25,000, earn quarterly cash flow, be an owner of hundreds of properties, right? Is kind of the idea. And not deal with the guests or the pricing or the design or the acquisition, or if you've ever done a syndication, it's exactly the same types of benefits you get. The asset class is just different in being short-term rentals. 2022 is our first full year. We ended 2022 in our first fund with a little over $37 million in capital raised.
Wow.
So really a lot more demand than we really expected. And I think that was a testament to the performance that our team has really driven. And today we are on our second fund, while also scaling and maintaining fund one. So we're excited to continue that path.
Yeah, you guys are at a crucial spot, to have enough credibility. I mean, it's going to be kind of the hockey stick at this point, with people's attention and their desire to partner with what you guys are doing. But give us the origin story with your background in tech, maybe even before Facebook, while you were there at Facebook, and then what would cause someone who is so entrenched in the tech industry to want to invest in real estate? Because they kind of seem like oil and water in a lot of ways. Obviously, you've got big incentives to invest money into the stock market, into the stock with the company that you're working with. So why would somebody want to go into real estate?
I mean, outside of diversification, for sure, right? It's ironic. I don't think I ever bought Facebook stock while working at Facebook,
Oh,
right?
wow,
Because
that's
I was
funny.
getting paid in Facebook stock anyways,
Right,
right? So I almost bought everything else. But I was, really two reasons kind of led us to short-term rentals. The first one is when you are going through a huge influx of growth within an organization, which is what Facebook was going through. We were opening up offices left and right. And when you open up an office, say like you're opening up a new office in Boston, it's not like you're hiring a one person or a team and calling it a day. You have to understand where these people are going to eat, sleep, play, where their kids are going to go to school, because you're trying to attract talent to this Boston office,
right.
right? Again, this is pre-pandemic, before remote was a little bit more common. And you would show up and we would go there and we'd figure out the infrastructure, right? Like, what does corporate housing look like? What is this? What do the benefits look like? And you're there for a couple of weeks. And when you're there, we stayed in a couple of Airbnbs, and while we had some great experiences, most of those Airbnbs were pretty shitty, especially for the price we were paying. So I always wondered, I was like, why are these so shitty? And a little bit later, I would become an LP in a lot of syndications, predominantly because I was a privileged higher income individual living in California who was looking to offset taxes. And I was like, real estate would be good. So I started getting involved there, and I started realizing that operators looked for scale efficiencies that existed in markets, but scale inefficiencies was something that people didn't try to target because it was really hard to do.
Mm-hmm.
Coming from Facebook, one of our biggest advantages when we thought about talent, technology, and just growth in general is about targeting scale inefficiencies, right? For example, acquiring Instagram back in the day, one would argue was a scale inefficiency. Rolling it into the Facebook infrastructure allowed it to infinitely scale, more so than it could have scaled by itself. And so by applying that to an asset class of short-term rentals, and Sabrina and I, who's my founder, my partner and co-founder, have owned a couple of short-term rentals. We're like, if we could solve for the efficiencies of scale and turn this into a scalable asset class, we would have an incredibly difficult, and hard competitive advantage that people wouldn't be able to compete with.
Yeah.
And so we solved it, starting with technology. We built software that allowed us to identify hundreds of thousands of properties that we could acquire and that get automatically underwritten every single month. So, we came from a perspective of technology, of being a user, of seeing the scale inefficiencies, and we packaged that all together into a offering, for lack of a better word, that made sense to your day-to-day investor, right? Broke down the challenges, the hurdles, and made it really simple to get involved.
That's really interesting. I always love to talk to our guests who have a different background and weren't kind of born and bred in real estate investing, because invariably in every scenario, there's a skill set that you developed in another industry that you were able to monetize and find success in, and then have that translate to real estate. So, all of the problem-solving stuff that you developed at your time in Facebook really allowed you to find an overlooked area that hadn't been done at scale. Because you're right. I mean, a lot of people do VRBO. Hey, I want to live on the coast, so I'm going to go buy a second home there, and I want it to pay the mortgage. Really low-level stuff, which is great. But how do you do this at scale? So explain a little bit on the underwriting software that you guys either did you code that from the ground up? Did you take an existing platform and rework that? And then what does that process look like when that algorithm's looking? Where is it pulling the data from, and what are the underwriting metrics you're looking for?
So we built that platform from scratch. So both Sabrina and we do have tech backgrounds, and we do have certain advantages in understanding how to understand complex data sets, which is really all that our software does. Is it takes a lot of unstructured data,
right,
and structures it so that way we could actually make sense of it in real time to make certain decisions. And so that software, in short, takes the MLS, right, or just listings across the country. And as they hit the market, we're underwriting them as short-term rentals in real time. And 94% of the time, the deal sucks, right? It doesn't pencil as a short-term rental for a variety of reasons. Now, our software doesn't tell us, the bones of this home suck and it's going to require a significantly larger design budget. It doesn't know that, right? What it's taking is the base information that's coming from a listing and pairing that with both public and private data that we have access to for short-term rentals all across the country through our partnerships with companies like an AirDNA, right, as well as several others, and then basically saying, the price to rent ratio here is X to X,
right,
and therefore it'll probably make sense when we assume these assumptions that we implement per city, per county, per state, et cetera, and therefore it feeds it into a feed, very much like a news feed of properties that our head of acquisitions and our team can actually look there and say, that property makes sense. Let me go actually further underwrite it. So I want to be clear, we're not a technology company that does real estate like an Opendoor or a Zillow. And we're not iBuying. We are, in fact, a real estate company that happens to build technology to do our job faster, easier, and more efficiently, right? And so those are the reasons and things that differentiate us from the fundamentals, right, of a technology company and the fundamentals of a real estate company. In fact, if you look at arguably one of our biggest advantages is the level of caliber and talent we have on our team. And you talk about unfair advantages. When I was at Facebook and scaling, thousands of people, one thing I can tell you for sure, no company is greater than the talent that it has. Right? And the reason Facebook succeeded and will likely succeed in the future is it has an incredibly high bar of talented people who work there who are incredibly smart at what they do. And so we took that very same approach. We've hired the best possible talent from companies like Vacasa, DR Horton, Apple, Facebook, and several others, where we brought in our advisory board comes from places like Uber, Bigger Pockets, AirDNA, right? So we brought really the best minds in the space to create an unfair competitive advantage in building and understanding an asset class that's very much early in its infancy.
So I think one of the things that's always stuck out to me, and maybe you'll even be able to cite who the author was in this book, but it's the life cycle of how ideas are adopted. And, I forget the guy's name. I'm going to find it. We'll put it in the show notes. It's a good book. People have taken, though, it's a graph. So you have like the innovators are the first ones to bring an idea kind of into fruition. And they're the ones that are like buying Tesla, pre-ordering it before it was, proven, and figuring out all the kinks. They were willing to take that on because of they were early, wanted to innovate and be a part of that. Then you have early adopters, and then you have the early majority and the late majority and the laggards. So in this space, you guys are coming out with a fresh idea, a fresh take on things. And there's probably a lot of the people on your team are by nature innovators, right? Some people who are like, I want to be a part of working out the kinks and bringing this into the mainstream.
I totally agree. In fact, that's almost exclusively what we hire for, are people who can problem solve and navigate. So what we look for in terms of talent is, yes, industry experience and knowledge. I think that's by default, right? Being able to apply something, but curiosity, problem solving,
Yeah.
and passion, in addition to grit, are going to be your 3 to 4 things that we look for inherently. First and foremost, we're an early company. There's most of the things we need aren't built,
Right.
right? And they don't exist, right? So you have to go out and figure out how you're going to solve these problems, and navigate them. In fact, even when we first started, right? Like today, we're a vertically integrated company. We handle acquisition, design, property management, revenue management, everything through and through. But that's not how it started, right? Like when we started, we were like, we're really good at this technology acquisition part. We'll raise the capital and then we'll hire, right? Outsource to the experts in the space, the Vacasas, the Avantstays, the Evolve, smaller companies, whatever, right? For them to be our vertically integrated partners, for lack of a better word. And then they couldn't deliver, right? And at least to the level of caliber we needed, right? We needed someone who could scale both an operation, scale property management, scale construction, scale design, and not just in one market, but across 12 markets, 3 time zones, simultaneously, at scale, concurrently, not consecutively, and deliver and take care of our homes the way that we would care for, right? And what we learned very quickly is that as the market changed, right? Because you look back at early 2022 to end of 2022, interest rates doubled. Right. Literally, no one underwrote for that. I don't care what industry you're in. You did not sit there and be like, I'm looking at a 3% today. I'm going to underwrite at a 6.
I'm going to stress test this deal. I'm going to double the interest.
You're not stress testing at a 2x, right? Because you wouldn't do the deal. You'd be terrified. You'd almost short the market at that point. Right. And go from there. And in addition to that, you had these companies who were struggling. I think Vacasa is an incredible story of a company that grew too fast and bleeds CAC, right? In every possible way. I think Avantstay did too many things, but I think they're fantastically led by Sean and his team. I think they have an incredible future ahead of them. And then you had Evolve, who was trying to tackle the shorter end of the spectrum by not offering full service, and then everything in between, right, of the other companies. And for us, we were like, you're delivering a product that looks and it feels and performs like the average of the market. And that's not what we demand, right? We demand top tier, best performance, best looking, best revenue, best in class. And that didn't exist, right? So we could have crumbled and told all our investors, like, look, this is going to go to shit real fast, right? Especially with the rise in interest rates, or we could adapt. And so we adapted, right? We built our own opco and our own operating company and our own scalable advantages through design and renovation, pricing and revenue and everything, and built a model that was effectively 70% cheaper than working with these companies, was better in terms of performance, right? In a Q4 of 2022, we released that we performed 71% better in terms of revenue than our competition, which was these professional management companies. So those are the types of things when you're hiring, and to circle back to that, who can go solve these problems, right? Who's passionate about them and who's going to have enough grit to actually fight through. And any one of our investors that we talk to, they'll tell you, we stress the importance of team, technology, and traction as the 3 T's as to why our competitive advantages are in the space. We're innovative. We have the team to execute it. We have the technological advantages to perform. And we actually have our first level data to actually go make these decisions. So all those things go in hiring the best kind of caliber people.
So this is a little out of order, but one of the questions I had down here was, are you concerned for short-term rental as an asset class with where we're headed economically?
0. In fact, data actually tells you people travel more domestically in recessions. So the way I try to correlate this to, say, commercial real estate or traditional commercial real estate is in really up markets, your class A type investors or economic people are traveling actually more internationally, right? And class B is almost traveling more class A domestically. In recessionary times, your class A is actually coming down and trending towards like a class B destination. And class C is typically staying within class C anyways, right? So, and I'm comparing this to like how you look at like class A and B and C multifamily, right? For those who are listening. And our entire strategy in terms of locations and where we buy hinges on geographical diversification, geographical seasonality. Because remember, we have a portfolio, it's not a single asset, right? And more importantly, drivable destinations from major metros. That's our thesis, right? So, COVID, people talk about it as like, people aren't, how's that going to affect the economy? And for us, we're like, it accelerated permanent changes in behavior, which was more remote work, more flexible work, more freedom that people wanted, right? I mean, I take way more trips. In fact, when we were raising the first 6 million, I was on a beach in Cancun, right? Like taking calls. If you would have told me that 2.5 years ago when I was at Facebook, I was like, that would have never happened.
Right.
And today people can't imagine going back. And if you go back to the 90s when storage was laughed at as an example, and then this thing called Amazon came up in the 90s and the dot-com boom happened, people needed a lot more place to store their stuff, right? And houses started looking differently, garages started looking differently, behaviors changed. People started buying more things because they had access, right? So what we're doing is we're investing in the tailwinds where we believe in the next decade and 20 and 30 years, I don't actually believe people will own homes. I think people will own interest in homes potentially, or it'll be a rentable society. I don't think the American dream anymore is own a home, own that experience. I actually think it's own your time and own your freedom, which actually means the opposite, to not own your assets, right? Moving forward. And I think that's a hard reality for some, but I think it's a reality that many will have to accept in the future.
Yeah, that's wild. You just hit our list. You just hit us with a lot there. That's kind of like a futurist type stuff, but when you're innovating, you're always looking out ahead and trying to interpret those behavioral patterns. And this is even real estate. Everything's boiled down: economy, business, commerce, society. It's all boiled down to emotions, behavioral patterns, psychology. And it's crazy to be able to take these abstract things and then like synthesize them into a strategy that can be monetized. So, going back a little bit, you're saying, hey, honey, instead of us going to Europe this year, we're going to have to cut back a little bit, and we're going to go, to Gatlinburg and get a cabin for, a week and bring the family there. So you feel like by being Class A and kind of at the top of the product of what's out there on the short-term rental market, there's always going to be an end user in mind.
100%, but also I think, and just to be clarifying, we don't actually believe in luxury STR, at least not today, right? So when I say Class A, I'm talking about us delivering the most juice out of the product that we buy. And for us, that looks like a $500,000 to $600,000 home on average, usually. That is accommodating a group, right? Usually 7, 8, 10, 12 people, because we don't compete with hotels, and pricing at the top end of the market because we offer way more things in our homes than you would get in a traditional short-term rental. They're well amenitized. We have things like everything from your hot tubs to game lounges, to pickleball, to volleyball, to pools, to mini golf simulators, all of those types of things. We're crafting an experience where, Uncle Bob down the street, who's got a decent looking STR with his iPhone 4 camera that he took his photos on Airbnb, and you guys know exactly what I'm talking about, right? Like, he's really happy making $1,000 a month in cash flow and like renting it out sometimes, and it's low key and it's low effort, and that's fine. We are the institutional operator that's juicing every ounce of profit while simultaneously really caring about the experience that our guests are having, right? Because that's going to drive our reviews, drive our rankings. And at the end of the day, Airbnb is simply a product with a user journey where they want their users to experience something, of which we, on the other hand, are delivering, right? And that's why we have a really great partnership with them and VRBO and some of these other platforms.
So one thing I wanted to maybe bring up, so usually when people invest in short-term rentals, I mean, if people have single-family house, rentals. Sometimes, in our area, they're like, oh, I'm going to try a short-term rental. And typically it's a little bit more risky because it's not that long-term lease, not a 2 or 3 year lease. But usually it's kind of like the risk versus reward. They're able to squeeze some more money out of their property and get higher returns. And, for them, it's kind of worth it. So how's that boil down to your investors as far as returns go when you compare yourself to other syndication companies out there? I mean, do you feel like you guys, because your margins are so much higher and in the short-term rental space, that you're able to outperform other syndicating companies, or where does that kind of shake out?
I think first and foremost, you can't look at multifamily and short-term rentals as the same asset class. They offer totally different risk reward profiles, in my opinion. And I'm a believer in both. I'm an investor in that, mobile home parks, everything in between. Short-term rentals and our specific strategy and why our operating model is what it is focused on driving better yield, which is cash flow, right? At the end of the day, it's a cash flow focused investment. And then 2 is packaging these properties over time in a portfolio and selling them based on revenue, aka cap rate, not based on value, right? And therefore, we optimize for NOI, which is exactly what you do in multifamily. So that being said, investors with us, and this is not a solicitation, of course, got to say all those types of things, and this is only for accredited investors that we work with. But investors with us, it's a 25K minimum. You're looking at 7 to 12% average cash on cash. You're looking at roughly in that 2x equity multiple every 5-ish years. Very similar metrics that you'd actually find in multi. The difference is where the money comes from. So with us, you're going to get significantly better yield, right? In multi, in a class B value add, if you're getting 3%, 4% cash flows, do you ever hit your pref? Usually not. You don't actually hit your pref during the hold. Right. We actually will hit our pref in the hold.
Gotcha.
Right?
Yeah.
So those are 2 very different types of strategies, right? One is very much like set it, forget it, and I'm going for growth and call me in 5 years. The other one is like very operationally heavy. And for us, I think at the end of the day, it's about scale. Scale is really important. In multi, you have scale in that building, usually, right? You're buying a 200 unit building or whatever. But we're driving economies of scale across the portfolio. Also, it's a lot harder to do what we do than it is to do what multi does, right? Which to us has a much more competitive moat. And the last thing, and probably the most important, in multi, your margin of error, in my opinion, is super small. You're competing against institutional equity, Blackstone, BlackRock, and all the big boys and girls in that space. People who are incredibly talented, a mature asset class, who are naturally vertically integrated in many companies, right? Mm-hmm. And in our asset class, we're competing 95% of the time against mom and pops.
Wow.
Yeah.
So yes, we have advantages, but also multi way back in the day was here, right? Yeah. And then you saw cap rates compress significantly, right, over time as institutional demand got in. And that's why we believe we're early, but as institutional demand comes in, and you're already seeing it with single family homes in general, right? But as institutional demand comes in, cap rates will compress, which will drive shareholder value by nature.
That's true.
Awesome. Well, we're going to jump into our smaller pockets segment. So, Sief, go ahead and tell us about your worst real estate deal. And so what happened? Where did it go wrong? And then, most importantly, what did you learn so that us and our investors can avoid the same mistakes?
I think for me, one of the worst real estate deals I've done was probably one of my first, and I wasn't even in my adult years. I was in my younger years with my family, and we bought a piece of real estate out of state, and I took on all the risk without any of the reward. And I think I did that at the time because no one in my family believed in real estate. I'm a first, I was born here in the U.S., but my family is, from overseas, and they immigrated here. So they're very much like the stuff the mattress type, right? And I used to joke with them, like both my family and extended family. And I really wanted to buy this piece of real estate, and I was young. And so I got my uncle to go on it with me. But he was like, look, you're going to do all the work. I'll put up half the money. You put up half the money. But if everything gets lost, you're going to lose everything. And I had no idea. It was my very first small, tiny taste of what a general partner would feel like, right? On a really small scale. And then the market went to shit. It was, wasn't the greatest debt terms at the time. I didn't understand a lot of things. I was probably like 17, 18. Um, and I learned a lot about not to do business with family. That's one part. Um, that was a painful lesson. Everyone would eventually get their money back over time. And two, buying out of state then, I mean, we're talking like what, 13 years ago or something, was terrifying. Right. Like now it feels very normal, but like 13 years ago it was terrifying. And like I had a very different progressive mentality than at the time my partner, which was my family. And they were like, oh my God, you have to go see it, have to have eyes on the asset, right? Touch it, physical ownership. And I was like, no, we'll just do it like, let's throw up a camera or something. Right. And so what that taught me very early is aligned interest with who you're investing with. And that's kind of a lesson here is we work with investors who believe in us, believe in the asset class, believe in the market, believe in the tailwinds, or a combination of all of them, right? Of some sort. And they have to be willing to go for the ride. And I think any general partner will tell you the best investors are the ones who are willing to go along for the ride, knowing damn well, and I think any general partner would also agree with this, the business plan you put forward is rarely the business plan that's executed.
Right.
And it's because everything changes.
Yep.
And ours already changed, right? Like we had interest rates double. Like, what do you do? Right. You had, your property management infrastructure that you thought you would work with didn't work. Right. So like, how do you navigate that?
Yep.
I see a lot of people buckle rather than try to solve the problem. It's a lot easier to give up on those types of things or rather go build and fix it and figure it out. And for us, that was a big lesson is, always have people who are willing to figure it out, both on your team as well as your limited partners. So those are important, especially in tough times.
With that deal with your family member, I mean, did you end up losing money on that piece of property, or did it never...
30 grand?
Oh, nice. So
yeah, it was a lot for me at the time.
Yeah, right? Was it a single family house or was it a piece of land? And
single family.
It just didn't work out, huh?
Didn't work out. We'd eventually, he'd get all his money back. We sold at like a 60% loss, and I got a little bit of my money back. But it was the best lesson in a world of lessons that I didn't know I needed yet.
Yeah.
Right. And I hated real estate for a while, just because I just didn't understand a lot of things. But looking back on it over these last few years, I go back to those times. I'm like, those are things that I'm happy happened. It was an expensive education then.
Yep.
It's an incredibly inexpensive lesson today.
Oh, that's good perspective, man. Wow, because it feels like so consuming at the time that you're working through something really painful and difficult. But time has a way of kind of reframing those things.
Mm-hmm.
All right, man. One of our last show segments is called our little Nugget. So the DJ air horn was my idea, by the way. So
I like that.
What's one practical takeaway or piece of advice that our listeners can implement to their real estate investing business?
Trust but verify, right? And I think in times of distress, it becomes really easy for people to cut corners.
Oh, wow. Yeah.
With people that you're working with, whether it's your agents, your lenders, your general contractor, your partners, whatever it is. But realize that in good times, everything is really easy.
Yeah.
And in times of distress, it's really easy to avoid talking about tough things. Talk about it. Talk about it. Talk about it. Talk about it. Verify it. I can't tell you how many times, even in 2023 here, as we're sitting here and it's only been 3 months, I've seen people's lenders pull their rug from underneath them. Yeah. I've seen people try to go after shady shit because it feels like a dog eats dog world. And it is. Business is very much like that. But you got to have thick skin, as we kind of joked about earlier, but verify in times of distress, double check your math, go through it, right? Trust your gut, right? And also stay in your lane. If you are really good at single family flipping in Cleveland, and that's what you've been doing, double down.
Yeah.
Times of distress offer really great opportunity, but you got to trust and verify a lot of the things that you're working with.
You mentioned your gut. There's a lot of weird psychology out there about trusting your gut. People call it different things, but it is a weird kind of abstract thing that everybody has to some level of like, I think I should double check on this. I think I should lean a little bit further and maybe follow up. And so many times, hindsight's 2020. It's kind of the whole cliche adage there. You look back when you didn't lean in on something, and you're like, I should have. And how many times do you have to do that before you can avoid, having to go through the painful lessons there? But what's been one of the greatest resources for you personally in your real estate investing career?
I think my ability personally, I think it's one of my strengths, at least in my opinion, is I always pretend or act and surround myself with people that are 10 times smarter than me. And, even with our LPs, I joke, if anything happens to me, the company would be just fine. Right. Because, our team is incredibly good. And I recognize my weaknesses a lot earlier than I think a lot of people my age typically do, right? I'm a younger general partner, 30 years old, where you typically don't learn a lot of these lessons until later. And so for us, we're a specialist organization, not a generalist organization. So we have 6 to 10 people who really drive and lead this company, who are really freaking good at what they do. And having access and resources to those specialists is not only a value to myself, but also a value to shareholders and people who are investing with us.
That's good. Yeah. We've, I kind of like that phrase of like, try and be the dumbest guy in the room. And no one's ego likes that, but there's honestly a weird kind of pride too of being able to kind of be the dumbest guy, because to be around people that are smarter than you is actually pretty difficult. Yeah. Because they've attained something that you haven't. And so there's just kind of this lull of the lid, of like, you can really only attract people who are at or slightly above your level. So it's actually a compliment. If you're around a lot of awesome, high performing people that are better than you, then you're doing something right.
It's the right room.
Right. Sief, how can people follow your guys' success at TechVestor? What would that look like? Whether it's through social, do you guys have educational stuff you like to put out there? What's the best way to follow?
Best thing is going to be, our LinkedIn. We post our properties and you can kind of get a sense of all those things. If you're interested in investing or just want to learn more, we're big proponents of education. So feel free to go on our website, dig around, request a call, right? We only work with accredited investors, unfortunately. So if you're non-accredited, it's not something we can, really work around. But also, follow along, get on our email list. Every week we're like, here's what happened. Here's our numbers and our performance, and get curious, right, about short-term rentals, and feel free to reach out to any of us. We're a team of 20 to 30 all across the world, who have very different perspectives on short-term rentals. And that's a good place to start.
Did I understand correctly at the Best Ever Conference that you guys offer a discount for shareholders on some of the places you own?
We do. So we are one of the only investments with utility, where you're an owner of these homes, so you can stay in any of them for a 10 to 30% discount. And it doesn't affect the investment, just because the way we're booking it's booking direct, right? So it doesn't affect the investment value. It just offers a value to the investor, for lack of a better word.
Sweet.
Yeah, that's a bonus.
You could plan your vacations around that. So awesome,
Yep.
man. Hey, dude, thank you
Exactly.
so much for taking time to come on today and kind of unfold and demystify the stuff for us. You guys are doing awesome things. We're excited to follow your success.
Thanks so much, guys, and looking forward to it.
As always, excited that you joined us on another episode of the Reinvest Podcast. If this episode added to your tool belt or left you feeling inspired, go ahead and share it with a friend. Stay tuned every Tuesday for new episodes. And if you want to get in touch with us, go to our LinkedIn or Facebook profiles and shoot us a message. Move farther, reach higher, and grow deeper. See you next time.